Welcome to The Explainer. Today we're unpacking one of the absolutely wildest tech stories of our lifetime. We're talking about the 17-year roller coaster of Bitcoin. Going from an obscure, rebellious little piece of code on a cryptography mailing list all the way to a globally regulated asset class, it's just nuts. Let's jump right in.
Right off the bat, when the pseudonymous creator, Satoshi Nakamoto, launched the network on January 3, 2009, they hard-coded a very specific message into the very first block, the Genesis block. It read, "Chancellor on brink of second bailout for banks." That was an actual headline from the London Times, and it perfectly sets the stage, right? This wasn't just tech, it was a direct, anti-establishment response to the 2008 financial crisis. The goal was a financial system that didn't need central banks or government bailouts.
Okay, to make sense of this massive history, we're breaking it down into 5 quick chapters. We'll start with the genesis of Bitcoin, look at early transactions in darknets, dive into the disastrous Mt. Gox collapse, cover the Great Block Size War, and finally, wrap up with regulation and market maturation.
So, Chapter 1. The Genesis of Bitcoin.
It is honestly staggering how fast this went from just an idea to reality. In October 2008, Satoshi drops the white paper, putting together existing cryptographic ideas, like Adam Back's Hashcash, into something completely new. Boom, January 2009, the network is live and mining. And by May 2010, we get the very first real-world commercial transaction.
But wait, before we talk about that first transaction, we really need to look at how Bitcoin actually creates its scarcity. It uses this brilliant mathematical mechanism called the halving. So unlike fiat money that governments can just print endlessly, the Bitcoin code literally slashes the mining reward in half every 4 years. It started at 50 Bitcoin per block in 2009, dropped to 25 in 2012, and then to 12.5 in 2016. It turns this abstract idea of digital scarcity into a totally predictable, hard-coded countdown that still shapes the market today.
Moving right into Chapter 2, First Transactions and Darknets.
Okay, so how were people actually using this stuff early on? Well, at first, it was worth basically zero. But then, May 22, 2010 happens. A developer named Laszlo Hanyecz posts on a forum offering 10,000 Bitcoin for 2 large pizzas. And someone actually took the deal. Back then, those 10,000 coins were worth about $41 total. Obviously, the cost of those pizzas today would be mind-blowing. But it was a massive milestone. It proved this code could actually function as a medium of exchange.
But we gotta be honest about what really drove early adoption. Between 2011 and 2013, Bitcoin was essentially the official currency of the Silk Road, an anonymous darknet market. Since you didn't need a bank account or a real ID, it was absolutely perfect for trading outside of government watch. A staggering 9.5 million Bitcoin moved through the Silk Road. It was the ultimate, unregulated Wild West era for the network.
Which brings us to Chapter 3, the Mt. Gox collapse.
So as all this unregulated trading started funneling into centralized exchanges, we got our first huge ecosystem crisis. Enter Mt. Gox. Now get this, programmer Jed McCaleb actually created it in 2006, but not for crypto. Mt. Gox literally stood for Magic the Gathering Online Exchange. It was for trading fantasy cards. In 2010, he pivots the spare domain to trade Bitcoin and eventually sells it over to Mark Karpeles in Japan. And this right here is a masterclass in the dangers of centralization. By early 2014, this repurposed trading card site was handling over 70% of all global Bitcoin trades. 70%! The entire ecosystem was basically relying on one massive, super vulnerable choke point in Tokyo.
And the downfall? Absolutely brutal. The warning signs were everywhere. A 2011 hack crashed the price on the exchange to literally a single penny. By 2013, the U.S. Department of Homeland Security is seizing millions from them for acting as an unregistered money transmitter. Then, February 2014, the final blow. Trading stops, they file for bankruptcy, and boom, it comes out that hundreds of thousands of Bitcoin had been siphoned right out of their hot wallets over several years.
So why does this history matter to us today? Because this disaster was the catalyst. Losing hundreds of millions of dollars forced global regulators to wake up. This specific collapse is what pushed Japan to create the world's very first formal, robust regulations for crypto exchanges, literally laying the foundation for consumer protection in the digital asset space.
Chapter 4, the Great Block Size War. So Mt. Gox was gone, but Bitcoin survived. But then it faced a massive internal civil war that almost tore the whole network in two. The core issue? Scalability. Basically, as adoption grew, the network clogged up, transactions got slow, and fees went through the roof.
The community knew they had to scale to handle global demand, but they fundamentally, deeply disagreed on exactly how to do it.
You had two deeply divided camps. On the left, you had the small blockers, backed by Bitcoin core developers. They wanted to keep blocks small so anyone could run a node on cheap hardware, prioritizing a highly secure, decentralized store of value. On the right, the big blockers, mostly major miners and companies. They wanted to bump block sizes up to 8 megabytes, so the network could handle tons of rapid, cheap transactions, functioning way more like a global payment network.
By 2017, the tension hit a boiling point. The small blockers proposed a clever upgrade called SegWit to optimize space without officially raising the block limit. But the miners, who wielded a ton of power, pushed back. That is, until the regular users stepped in. They threatened a user-activated soft fork, or UASF. By flat-out refusing to process transactions that didn't follow the new rules, the everyday users literally forced the miners to cave and accept SegWit. It was this incredible demonstration of decentralized power. But the big blockers weren't backing down from their vision either. In August 2017, unable to change the main network, they executed a hard fork. They split the code and created a completely separate cryptocurrency called Bitcoin Cash, featuring those 8 megabyte blocks they wanted. Bitcoin stuck to its cautious, small block path, and Bitcoin Cash went its own way. The community was fractured, but the Great War was finally over.
Finally, Chapter 5, Regulation and Market Maturation. After surviving hacks, bankruptcies, and literal civil wars, Bitcoin really had to grow up. But for a long time in the US, it was operating in total gray area territory. You had FinCEN saying in 2013 that exchanges were money transmitters. Then in 2015, the CFTC steps in and declares Bitcoin a commodity. It was just this confusing patchwork of rules. It wasn't until July 2025 that Congress finally stepped up with a cohesive legislative framework.
And those landmark 2025 laws were a massive deal for clarity. The Genius Act finally defined what digital assets actually were, giving legal backing to decentralization. The Clarity Act laid out specific compliant lanes for blockchains to raise funds. And the Anti-CBDC Act officially blocked retail central bank digital currencies, clearing the runway for private, market-driven options. The legal void was officially filled.
And man, the market responded to that maturation. By the fall of 2025, Bitcoin hit an unbelievable peak price of $126,000. When you contrast that immense institutional wealth against its literal $0 start right after the 2008 crash, the financial journey is just breathtaking.
So what is the ultimate takeaway from this explainer? It's the sheer resilience of the technology. From an anti-establishment cypherpunk white paper, through the darknets, surviving the Mt. Gox implosion, navigating a brutal civil war, to becoming this mature, globally regulated asset class. Understanding those early chaotic battles is absolutely crucial, because it explains exactly why the network is as secure, decentralized, and structured as it is today.
Which leaves us with one final thought. We've traced the first 17 years of chaos and growth, but as Wall Street and global regulators fully embrace what was once a highly rebellious piece of code, what on earth will the next 17 years hold for the future of decentralized money? It's a huge question, and one we're all going to get to watch unfold together. Thank you so much for joining me on this explainer. Keep learning, keep questioning, and I'll see you next time.